video covers risk uncertainty in the capital asset pricing model. The capital asset pricing model is driven by the recognition that in order to benefit from diversification, most investors buy a large portfolio of stocks, either directly or through a mutual fund. When you have a large portfolio of stocks, risk is determined primarily by the covariances of the stocks with each other. You can see that in the formula for the variance of a large portfolio, and the easiest way to see it is in a table like this. Say you're looking at an individual stock, stock number 1. The risk of the overall portfolio is driven primarily by the diversification terms of these stocks with each other. Like I was talking about in the last video, if you had, for example, the S&P 500 where there were 500 stocks here, the number of rows and columns in this table is 250,500. 500 of them are the diagonal terms here. The other 249,500 are the off-diagonal terms, determining the overall risk of your investment. Well, each of these off-diagonal terms is dependent upon a covariance, the tendency of the stocks to move with each other. Now what we're going to do is we're going to say, okay, given that an investor has lots of stocks like this, what is the primary determinant of the risk contribution of some individual stock? Well, for an individual stock, what I need to do is look at that stock's row and column. There are 500 terms here, another 499 terms here, so 999 terms. One of them is the stock's individual variance. The other 998 terms are the tendency of that stock to move with each of the other stocks in the market. Averaging across these, what we get is the primary determinant of the contribution to risk in a well-diversified portfolio of adding stock 1 is the average covariance of the stock with all of the other things that you own. If you own a large investment portfolio, that's approximately the market. CAPM is based on that. The measure of risk in CAPM is the covariance of an individual stock with the market normalized by market variance. And what that does is make the beta, the risk measure, of the market 1. And that's just a normalization factor. So this is the risk measure for a well-diversified investor. Then you can ask yourself how much higher return an investor demands for taking on risk. Well, a unit of risk, a beta of 1 for the market, entitles the investor to the return that you expect to get in the market over and above the risk-free rate, plus the risk-free rate. So the additional return that an investor demands when they take on risk in the form of beta is determined by what's called the risk premium. So the market risk premium, usually what you call the risk premium, is the difference between the market return and the risk-free rate. Each individual stock has a risk premium that is determined by the overall risk premium and the amount of risk inherent in the stock, the beta. That would be the risk premium for stock I. But almost nobody says that term. Almost everybody just says there is a market or the risk premium, and you weight it by the measure of risk for the individual stock. Okay. This is called the security market line, by the way, if you ever read about the security market line in the literature. Now, in terms of risk and return, this is much easier than working with standard deviation. So the fact that investors have large portfolios actually is going to make things easier for us, because this is a fairly simple equation of a straight line. So you can learn a lot of things from this, and what we'll find out in class is that beta is additive. It works just like expected return, which makes things very simple. But the basic applications of the CAPM, well, there's basically 4 of them. If you have any kind of a question or a relationship that involves risk, the form of beta and returns, you know the CAPM is going to apply. So you know the expected return, say for deer, is equal to the risk-free rate plus beta times the risk premium. Now sometimes we'll say the risk premium is 5% here, and that means the same thing. So if you have the market return, you subtract off the risk-free rate. If I were to give you the risk premium directly, you don't subtract it off. Well, for all of these, what you're going to do always is substitute in what you know, solve for what you don't know. So in this case, it's pretty easy. You're just going to multiply this out. So 8.5% minus 3.5%. So 5% risk premium times beta plus risk-free rate, 3.5%. 8%, oh, I must have done something wrong here. 8.5% minus 3.5% gives a risk premium of 5. Beta 0.75 plus 3.5%. 7.25% is the return investors would demand on John Deere stock. Sometimes you know what return investors are demanding, and you can use that to estimate the risk. Again, you just start with CAPM, knowing rates or betas, asking about beta. So the CAPM equation says the expected return on John Deere, that's a terrible 2, is equal to the risk-free rate plus beta risk premium. We'll do a little algebra. I'll subtract the risk-free rate from both sides. And I'll divide through by the risk premium. Now notice this is the risk premium on John Deere and the risk premium on the market. This will be the beta of John Deere on the right side. And I can divide that by 1. That's the beta of the market. There's a proportional relationship between risk premia and betas. But here all I wanted is to find the Deere beta. So that's what I'll put in the calculator. 7.25% minus the risk-free rate. So I earned 3.75% more on Deere than the risk-free rate, divided by the market risk premium, 8.5% minus 3.5%, 5% more on the market. The ratio of those is equal to the ratio of the betas. So the John Deere beta is 0.75. Of course, you could solve this for anything you want. What would the return on the market be anticipated to be if you knew that any given stock has a beta and you can forecast the return for that stock? Well, it's the return on the stock is equal to the risk-free rate plus the beta of the stock times the risk premium Again, you do a little algebra. Subtract the risk-free rate from both sides. Oops, missed a 2 in there. I'm going to multiply through on the right side. And And at the end, I divide both sides by 75. So I'll put that in my calculator here. Let's see, 7 1/4 minus 3 1/2 plus, in parentheses, 3/4 times 3 1/2. I'm going to divide that whole thing by 3/4, 8 1/2. So you can see how easy these things are. You start with a linear equation, which is very easy to solve. You plug in what you know, you find out what you don't know. Little algebra is all you need. So let's do the last one. Of course, given any three, you should be able to figure out the fourth one here. If you know the return on John Deere, you know the market return, you can back out the risk-free rate. You know, people say that Treasury bills are not necessarily risk-free. Well, this is another way to get a crack at what you think the risk-free rate is going to be. So let's see, how am I going to do this? The return on the stock is equal to the risk-free rate plus beta of the stock, risk premium, I'm going to solve this, so I'm going to multiply through. Okay. Then to collect terms, so I'll subtract the 75 times the market return from both sides and collect terms on the right side on the risk-free rate. Divide both sides. And I'll plug that into my calculator. Just a minute. So 7 1/4 all right, minus, in parentheses, 3/4 times the market rate. Divide that whole thing by, in parentheses, 1 minus 0.75. Risk-free rate's 3 1/2. In addition to being simple, there's a whole lot of other advantages to CAPM and similar models called arbitrage pricing models that you will see in the investments course that make them, really, really very nice to use. And we'll talk about some of those in class, but this is the basic application of CAPM. So we're going to start with a risk-free rate. We're going to add a factor related to risk. For investors who are diversified, the factor that you should use is the risk measured by covariance in terms of beta and the market risk premium, or simply known as the risk premium, the return anticipated for the market over and above the risk-free rate.